Hi guys, this is Steve O'Hare from Signal Centre, and today I'm bringing you part of our basic trading education package, and we're in lockdown at the moment, so hopefully it'll give you an opportunity to have a little look and see how we look at support and resistance, which this slideshow or PowerPoint is all about. I've been in the market 33 years as a trader and a chartist, and hopefully I can pass on some of my experience and knowledge on support and resistance, which is a very key topic to discuss. Now, I'm going to go through the PowerPoint. It's about 11 slides, and we're going to initially talk about peaks and troughs, which is basically how the market moves. Markets don't generally move in a straight line. They form peaks and troughs of highs and lows, and that forms the charts that we see today and we use today to try and predict where the market is going. It's very easy to visualize it all when you do see these peaks and troughs, and I'll show you that as we go along. This is where we get support and resistance from a lot of the time, both from a horizontal and a trending level of peaks and troughs. So also I'll talk about role reversals. So a lot of the time when we have a good support level, if that support level is broken and prices move through it to the downside, when it comes to retest that level, which was previously support, we find often that it becomes a resistance level. It has to have a decent move through it, not just a little spike through, and we'll talk a little bit more about that. And it's obviously the same the other way around. If you have a decent resistance level and the market moves up through it, it becomes support. Also, I'll talk a little bit about the psychology, the market psychology of support and resistance, and how important it is in financial markets and trading. And finally, I'll go on to say a little bit about round numbers and how traders very much are attracted by round numbers. So let's move on to an example of peaks and troughs. I'll actually bring maybe a live chart in at some point as well, but this is generally what you will see. You'll see in an upward trending market, you'll see the market move. It will find resistance where buyers and sellers, who the buyers have been in charge as the prices move up, and then sellers will find a place of resistance where they are happy to sell, or buyers even taking profit, and this will cause a pullback or a correction, and then we'll find the buyers maybe that have missed out in getting in early into this move higher believe that this is a place where the value is, and they're happy to start to buy again. And what you'll tend to find that will then create a support level. And again, from here, sellers will realize the prices isn't moving down, and they will back away, and this will allow buyers to move further, the price to move higher towards the next resistance level. Now, all these resistance and support levels can be for a number of different reasons, and we can discuss them in live webinars moving forward, but I'll try and stick to the basics for the purpose of this presentation. So this is what you generally tend to find. This can be likened to Elliott wave, where we have 3 upward moves with 2 corrections, and so that will be form. Doesn't really matter on what time frame you're looking at. I'll be able to show you some examples of it today. In fact, I looked at one this morning which is pretty impressive, and I'll bring that over to you now. This is the Dow. This is a 4-hour chart, and as you can see, what we've had is we've had this move lower to resistance. We then get the reversal, profit taken at this level, and we've had a correction higher, and then we have the 3rd wave lower, and we get another correction higher. Let's click on it, and then the 5th and final move lower, and then we'll have an ABC correction, so that we're in the middle of that correction right now, ready to decide where the market's going to go on the next move. let's move that out of the way. Obviously, this is talking about an upward trending market. We have exactly the same in a downward trending market. So prices moving in troughs and peaks here, and we get the support, the rally back higher, sellers coming in again, resistance back down to the new support level. And obviously we've broken this support level, moved down to the next one, and it's rallied back before the next sell-off. So these are all reaction points that we can look at the market on a daily basis and see plenty of these over different timeframes. So what I wanted to talk about also was the role reversals of these, and this is how a lot of markets play out when we see maybe a change of trend. So we're looking from an upward trend into a sideways trend, then into a down trend. So something like this would see price action moving higher in the peaks and troughs, finds really good resistance. This might be on a higher time frame. This might be all-time highs. We've seen a lot of that over the last few months. And buyers and sellers, obviously sellers are stronger at the top resistance level, and price fades, and then buyers have another go. They still think they're in the uptrend, which is going to continue, but the sellers overcome the buyers again, and this is a formation which we will be covering and have covered, is a double top formation. So what we tend to find is when this neckline is broken, then that is a change of trend. The upward trend has stalled, and we're now in a sideways trend because the trend has been broken. We're not necessarily in a downward trend yet. So a break of this support, that's a sign of a change of trend. And what you do tend to find is this support does get retested and now becomes resistance. And then we'll have the move back higher, and the resistance holds, and we start the new trend, the downward trend. So moving from an upward to a sideways trend to a downward trend. So support is basically, as we can see from these charts, the support is a level under the market which has strong buying interest, and that's what it is. And resistance will be a level above the market which has strong selling interest. So just think about that when you're looking at these slides. Again, we can see the role reversal in a downward trending market, where value is found at this lower support level. And again, this is a double bottom formation, and we tend to find that if we break above this double bottom formation, there may be a retest. And also from these formations, you can actually have a good idea of where the next level of resistance will be. And it'll normally be the measurement from the support to the peak in between the two supports, and then extend that further. So you will draw that all the way up there, and you'll normally work out where the resistance will be. And also think about this resistance over here. That horizontal resistance is just as effective as some trend resistance is. Talking about trend resistance, that leads me on to trend line support. So how do we really find that trend support? Normally what we would do is join the peaks in a downward trending market, or join the troughs in an upward trending market, as in this example. Now this is obviously a line chart we've drawn here. You may look at candlestick charts or point and figure charts or whatever, but what you will be able to do is draw a trend line which connects those troughs, and the opposite would be in a downward trending market, you draw a trend line which connects the peaks, and that will form a trending support. Now when we talk about trends, the ideal trend in an ideal world, in an ideal market, would be a trend of 45 degrees. That's roughly what that is, and that would be an ideal world. But the world isn't ideal, so a lot of the time what you will do, the trend upwards may be in a slightly lesser degree, or as we've seen recently with the index markets and the stock markets, there's a very aggressive downward trend. So we've got to really try and work out which trends are really holding in. So we've got to really look at the market psychology of support and resistance, and you know, what we're actually looking at them, what we're actually thinking, what the market participants are thinking when they look at trend line support, trend line resistance, horizontal support and resistance. I've formed this diagram here and tried to try and give you a little bit of an explanation on that market psychology. So the market is full of different participants, and you'll have within that you'll have the bullish, the people who think that the market price is going higher. You'll have the bearish, the guys that think the market price should be going lower. And you'll also have a fair chunk of guys waiting on the sideline, waiting for their opportunity. They may have a trading plan which really doesn't take the short-term price action into consideration. So they're just waiting for their levels to be reached or their trigger to occur. So you do have but you'll always have these three categories of traders. And at any point, one of these categories will be in control. So they will be controlling the trend. So in an upward moving market, price action is stronger and moving higher. The longs or the bulls will be in control of that trend. And it's only really when they start to become more confident or become less confident, and the bears appear on the horizon and basically cause a stall in the price action moving higher. At this point, when we tend to see levels of resistance that we've previously looked at before, you'll have some of these bulls may not be as convinced, and their conviction may not be as good, and they will look to take some profits or alleviate some of their long position. And at the same time, you'll have the bearish traders who prefer to be short or looking this as a temporary move higher. They're looking at that opportunity to get short and get their positions on board. And what happens if we're talking about an upward trending market and the market has moved higher? Let me go back to this point here. You've seen the market move high, and the sellers of the bears have come in, and the market has moved back lower. And now, when we find a level of support, the guys who have been on the sideline, who have missed out on this opportunity to buy, or even the guys who were long and maybe have taken small profits here, they will look at the areas of support that occur in the market for an opportunity to get long again. The guys on the sideline will look at this as an opportunity to maybe step in where they've missed out before. The shorts or the bears in the market will look at this support level as maybe even an opportunity to take some of their profit off. So it's really all about how strong that trend or support and resistance level really is. So if we go back to this slide, we can basically, that basically is what makes up the whole market, and what makes the market move. You've got them three participants, and as I say, some of them are in charge and some of them are waiting at all at the same time. So also, when we talk about support and resistance, one of the major things to think about is how significant that support and resistance is. Now, this is also based on three main factors. And as we talk about, as we go through all these slides in education, you'll see the number 3 come up a lot. So one of the main ones will be the actual, how long ago the price action took place. So the more recently the price action took place on a shorter term basis, the more significant that is. And also, if you think about the time spent at that price, if we spend a lot of time trading around a certain price, so say the DAX is trading around 10,000 and it's a point of equilibrium, you'll get buyers and sellers on a daily basis trying to take control, trying to get long above 10,000 for the move higher, and the shorts or the bears in the market will be trying to get short below 10,000 to look for the correction lower. Also, the other thing to consider is the volume. So the more volume that takes place at a support and resistance level, the more significant that will be. So think about that. The more recently the price action, the more significant it is on a daily basis, on an intraday basis, the time that it spends there, and the volume that takes control there. So this is going back to maybe some of the moves that we've seen in the equity markets recently. We've seen these really sharp rallies higher, the real fast move higher on really low volume. So for us, if we draw a trend line on that, The trend line is a support, but it's not a very strong support because it's happened very quickly, and the volume that has occurred at that on that rally higher is not significant. So think about that. Another point to bring up is how creatures of habit we are as traders. We always like round numbers. I'm a sucker for a round number, so it's just the way I am. But the really key thing to think about is when we look at round numbers all the time, think about what other market participants are thinking about that round number. So if the bears in the market, if you're long above a key level, again, we'll go back to maybe something like the DAX around 10,000. If you're long around that key level, the bears will think, right, that's a key level for the longs or the bulls. Let's try and get it below that key level, because we know there'll be market participants who are weak in their conviction. They will have their stops placed below that level. So it's really important to think about that level when you're placing a trade, and also when you're placing a stop. Really, really key. Joe did a great PowerPoint on it yesterday, stop placement. Have a look at it. So avoid placing stops at the obvious levels. That's really important, because the bigger traders are, and the algos that have been built by these bigger companies are really hunting for those stops all the time. They're trying to take the weaker market participants out of the market to allow their longer term positions or longer term convictions to win through. So if you were to trade, if I was to be trading DAX, I always like to buy it at 13 or even sell it at 13, and there's a reason for that. Over the years, I've noticed, especially in the DAX, for some reason, it's always tended to find when it goes through a round number level, then you'll tend to find that the stops will trigger, and maybe it will take the market 10 to 15 to 20 points through that level before it comes off. So it'll flush the stops out and then it'll come off. So I tend to sort of, like, if I'm trying to sell the DAX and bearish towards it over a slightly longer time frame, I won't have my offer at 10,000. I'd have it at 10,013, which is because I do believe that when it gets to them sort of levels, the market's strong enough to take it through the level. On the opposite side of the coin, if I'm bullish on DAX, you tend to find that the market stalls just in front of the big round numbers. So I'll be looking to get long at 10,015 or 10,013. 13 is my lucky number, so that's maybe the way that comes in. It's not a round number, but that's where I'll pick. We'll all have our little quirky ways of trading. But you tend to find that the bigger traders or the funds, they like round numbers as well. So their big bid will be at 10,000, and they'll be looking to get a lot more on than I will. So you tend to find other market participants, the shorter term traders, will jump in front of that big round number. And obviously if it does break through, then that's significant. Stops will be the other side. So that's pretty much hopefully what I wanted to try and get across in this presentation. It's got dragged on a little bit longer than I wanted to, but maybe I can just show you a couple of charts that I've looked at recently. Again, that's the one I've just drawn on. This is another one. We can see the DAX on a 4-hour chart. We can see a trend line I've drawn in. I'm not sure what angle that's at, 45-degree angle, maybe a little bit less. But also the trend line needs 2 points. So and I'm going to do a PowerPoint presentation on trend lines, which may take place over 3 or 4 slides or 3 or 4 presentations. But you can see that on a 4-hour chart, it touched. This is the start of it. There's the second point. Now we can draw a trend line. This trend line's been drawn in, and price action stalled just in front of that trend line. So, other people were looking for that trend line. Again, let's break it down on a smaller basis. We can draw other trend lines here. And I believe these will act as support. Now, this is a little bit of a triangle formation, even possibly a bullish pennant. So there is an opportunity for this. If this fails, I will look at a break of the trend line first. then I will look at this horizontal trend line, which was the previous swing low, and I would consider a break below that to be negative, and it will look to target an extended move lower, potentially to this trend line. That's just a quick, brief live example of trend line support. And any questions, obviously, feel free to ping me on either Skype or email me. Is there any questions, Joe, from any of the group?
No, all good.
Excellent. All right. Well, thanks a lot for joining me, guys. And Joe's on at 12:30 or 1 o'clock this afternoon, and Ian will be after that. What are you talking about, Joe, later?
I am doing risk management and position sizing.
Lovely. Okay. Tune in then, and any questions, fire them across to me. Thanks, guys.
Cheers, Steve.